So now I'd like to turn it over to our community bank discussant. Craig Goodlock is the chairman and CEO of Farmers State Bank in Munith, Michigan. He's the only banker in Michigan to have chaired both the Michigan Bankers Association and the Michigan Association of Community Bankers. And in 2009, he was voted Michigan Banker of the Year. So Craig, take it away.
Thank you. What fun, isn't it? This is, my third time coming to this conference. Thank you, Karen Lawson, who's our director of the Office of Banking for the Department of Insurance and Financial Services in the state of Michigan. The last two times was sitting out there without an opportunity to come up here and comment other than clicking that little microphone on, which I love to do. Early this morning I leaned over to Mike and I said, you know what? I am ready. Give me the mic, give me the mic, give me the mic, because this is just fun stuff. Thank you, participants, for your papers and the opportunity to comment. I have to give even a more vibrant disclaimer. We see the disclaimers like Padma did with regard to the work for the Fed. Gary Peterson said that to his commissioner that his statements were not that of his bank. I'll even go further to say, given the fact that I've sat in some of those chairs representing bankers in a lot of different venues, my comments are not those of all bankers as well. They're really all mine. Let me tell you just a little bit about Farmers State Bank. In 3 years, we'll be 100 years old. It was formulated in 1922 by about 64 local businessmen and women in South Central Michigan to be able to provide financial services to a small, very vibrant farming community at the time. The railroad had just gone through town and they had a depot and it was time to have a bank. And so we are not a family-held bank. We're very widely dispersed. My stockholder with the most concentration of ownership is at 6%. We have a guy that's buying some and he's pushing his way clear up to 5%. This guy right here, who only gets stock ownership by taking money out of the savings account or away from the kids' dinner table, has a whole whopping 1/2 of 1%. And so that's truly what we are at Farmers State Bank. When I started in 1979, right out of college, having been asked to come interview by a local director whose daughter was having a birthday party, and I'm at the birthday party. He says, Craig, I understand you're going to be looking for a job. I said, yeah, I will. Why don't you come interview at the bank? I thought, last thing I want to be is a banker. I'm a dairy farmer's kid. I don't want to be outside. I'm going to do some farm stuff. And it felt so good going back home. I got my first loan from Farmers State Bank when I was not yet 18, back when we could still do that before the attorneys stuck their nose in our business and said you had to be of the age of majority. My dad co-signed and bought a motorcycle. My dad took it down the road and wrecked it. So I'm coming from that kind of perspective in the kinds of things that we talk about. $17 million is what the bank was in footings in 1979. We've grown it to $80 million today. We still only have 3 offices. If you draw a triangle from Ann Arbor, Michigan to Lansing, Michigan to Jackson, Michigan, our market pretty much is in the center of that triangle. So we're rural communities, but serving primarily as bedroom communities for those larger cities. And we have ag around us, but as we'll talk a little bit later, there's a reason we don't have an awful large ag portfolio. I'm not going to take the papers in the same order they were presented because for me they tell a bit of a story as we go through them. I want to start off with a reliance on third-party verification with Yadav's paper. And there's an awful lot of interesting conversations there when we were in the midst of our conference call preparing for this presentation. The comment was made, as Yadav made the point just a few minutes ago, that he saw this as being about examiner behavior. Well, let me tell you how third-party reports go in my bank. And again, that disclaimer, I'm only speaking for my bank. There's a level of risk there is to coming here and presenting because I've got my fiduciary examiners sitting here in the room. So the things that I admit can and will be held against me, I guarantee you. So when we go back to that CRA exam discussion this morning, do bankers cram for exams? Heck yes. You better believe we do. There is a direct correlation between how long until that exam is going to happen and how much effort we're putting into those loan files. And when that list of loan files gets pulled, do you think we stick our nose into them again before we put them in the conference room where they're going to meet? Heck yes. To make sure that they're as clean as they can be. And if this distance from exam office makes a difference, I'm only 35 miles from Karen's office. She did her first job as EIC in my bank. I won't tell you the year because it makes both of us old. So I guess that might be a reason why we're still here, 35 miles from the examiner. There is no substitute for direct examiner regulatory exams. Let me say that. But here's how a third-party review goes. We do our due diligence. We hire somebody. I'm going to talk specifically about loan review. The loan review report comes in after they've looked at all the selected files. We look at that loan review report and we start to tear it apart. And we tear it apart because we know it's going to be handed to the FDIC or the state of Michigan. And the first thing they're going to do is determine their scope of how many files they pull based upon the items that are in that report. It's not because we're afraid of the third-party provider. It's because examiners carry a big stick. And we want to make sure that what we do is the best and what we present to them is the best. So that third-party review for us is a preliminary view of what our people are doing and how that's going. And we look at it and we make sure, this other thing you have to realize is that examiners don't come in and just automatically tell us, you've got to downgrade all of these loans without us having some level of argument. You better believe we argue, because there are statutory guidelines for what makes that loan classified. And we make sure that if we're going to classify it, it fits within those parameters. Let me just highlight that there is only one group of people who are responsible for that call report, and it's management. We're responsible for the preparation of it, and we sign every quarter, and my directors do too, saying that we attest that it's accurate information. We're the ones responsible. Examiners do not change the call report. Management does. Sometimes with a little help from examiners. So, my bottom line, I think third-party reviews have a place, but we have to be careful about the cost versus the benefit. And we have to remember what those pieces of information are used for. I want to go next to the risk shifting and regulation and government assistance on this, and I find some very interesting things. First, Padma's paper. I was a math major at Adrian College. I took every 300 and 400 level of math at Adrian College, save one. I wouldn't take the last one because I already had a 4-point in my major going in. I didn't want to screw it up. Graduated summa cum laude. But when I look at the calculus and the differential equations that are in her paper, I understand why it was I didn't become a researcher, that I'm a practitioner. That's the deal. I understand that. I was in the banking industry in the times that you studied. I was working there. I started in 1979, you see. I remember the disparaging remarks we used to make about those S&L guys. They don't know what they're doing. Look what happens to their institutions. Some of those came back to haunt us just a little bit in 2008 and there beyond, you see. But here's what I want to point to. I'm going to quote several things from the paper. Increased accumulation of securities by stock institutions, you made mention of that a little bit, Mike, that Padma, you didn't spend an awful lot of time on that, but this is where I want to focus my comments. Relative to mutual institutions, following the policy change provides evidence in favor of risk shifting by equity holders prior to the policy change. And, in another place, the composition of investments in real estate within the thrift's own balance sheet also declined among stock institutions relative to their mutual counterparts following the policy announcement. However, there's two more statements that give me, I think, and all of us should pause to note. These findings show that the realignment of stockholder incentives is an important channel through which policy changes concerning deposit insurance and resolution can affect financial institution behavior. Followed by, in part, this statement. This paper demonstrates that the internalization of such signals by shareholders will be crucial for the policy, and the policy being the orderly liquidation authority of the Dodd-Frank Act, to succeed in its intended aim of curbing moral hazard effects associated with the expectation of assistance. In other words, the focus is on stockholders internalizing the ramifications of what's going on in the institution. For instance, my bank went 7 years without paying any dividends. You don't think my shareholders internalize some of that? So how is that important when we start to talk about policy? I'm going to talk when I do the next paper about the fact that my most vibrant competitors either have no stockholders or are GSE with current governmental implied guarantees or are tax exempt. Okay? That's powerful when you think about the implications of if the Dodd-Frank, that portion of Dodd-Frank, is not going to be effective without the internalization of equity holders, and when you look at competition and the corporate structure of that competition. So let's go to that piece. Deregulation, market structure, and demise of old school banking. I entered banking in 1979. 363 was the way it was. We opened up at 9 o'clock. We closed at 3 o'clock, 5 days a week. We were one of the rare ones who was open on Saturday morning, 9 till noon. In fact, it had only been several years before I started. My bank was open from 7 o'clock at night on Saturday night until 8:30, see. But most banks weren't. In fact, some of them were closing on Wednesday afternoons. I told you I was a dairy farmer's kid. This was cool. You could go to work at 9 o'clock, be done at 4. You had plenty of time to milk cows, plant corn, whatever it was you wanted to do. And I really wanted to be farming. This gave me time to do it. I remember the arguments that we used to have. In fact, that's why there's 2 banking associations of which I have chaired in the state of Michigan, because one was set up exactly to be able to stop that kind of competition that came from other states. Michigan Association of Community Bankers. Michigan Bankers Association was on the other side. Those free market people who said, just let us compete, open this up, it's a good thing to do. Quoting from the paper, banks responded rationally by increased risk-taking, developing new sources of non-interest income, and using acquisitions to increase scale and reduce competition. The paper, for me, raises interesting observations from the consumer perspective. Mike, you alluded to it just a little bit, and I think you did too, Yadav. Net interest margins were squeezed by competition primarily because of an increase in deposit rates. That's good for consumers, we'll assume. The banks offset this reduction in earnings by moving to more fee-based income. I don't think that's so good for consumers. Overdraft fees, we know about those programs and all that kind of stuff that, by the way, regulators kind of frown on these days, at least the CFPB, if you want to count them a regulator. So, banks moved to new services by lobbying for and obtaining various insurance and wealth management powers. We got insurance powers. We got the powers to sell various kinds of annuities and that kind of thing. We'll assume that's good for consumers. Banks took on more risk in their loan portfolios. Well, we saw how that played out in 2008 and beyond, didn't we? From 1966 to 2017, the number of banks in the U.S. fell from 24,000 to under 6,000. That's good for some consumers. It's not so hot for some others. I started my career, like I said, at a time when we were a 3-6-3. I could make it to every volleyball game. I could get to the girls' piano lessons. I could play in that golf league if I were a golfer. And we could do all of those kinds of things. But then we started to see what we could do with competition. And I was excited. I left the bank in 1981 and went off and did some other kinds of things. I even tried my hand at farming until I decided there was too much money to lose. Came back in 1984, been there ever since. It was fun all of a sudden. There were things we could do. There were opportunities. But I understand what this competition is doing. My daughter works for a regional bank right here in this Fed district. And right now she's contemplating going to work outside the banking industry because her bank is just sold. And she's going to have to move across state lines if she's going to keep working for them. So I leave you with this last story. The other day I was walking out behind the teller line and one of my older customers comes up very downtrodden. I said, Don, what's wrong? He says, I feel like I'm getting a divorce. Well, I know he's a widower. So what's with a divorce? Because I'm pulling all my money out of the IRA. I'm taking it up to Lansing. Because in Lansing, they're paying a whole lot better rate. Every week, I use a third-party service to pull CD rates in my local market. Last week, that report, on which we pull on 7 financial institutions, the top 2 either don't have any stockholders or are tax exempt. The other 5 in that are all stock-held institutions. For the purposes of what I'm going to tell you, I didn't use the bottom 2 to be able to get them because it would have skewed the numbers even further. So I looked at CD rates between the top 2 who are not stock institutions or are tax exempt, and the next 3, and my bank is in the next 3. 2 of us are local community banks, the other one's kind of a regional bank within the state of Michigan. On certificates of deposit from 12 months to 60 months, those first 2 I mentioned are paying 80% more, not 8%, 80% more than the average of the 3 stock institutions. So, I love to compete. It's what's kept me in the banking industry for 40 years. And I intend to stay because I'm still having fun. And we're still doing, these videos that show and all the compliments we get and all the wonderful things we do. I leaned over to Karen at one point and I said, I feel so angelic. It's just cool. So I love to come here. If you're going to use this information for policy making, level the playing field. I love to compete, but don't make me run uphill all the time. Thank you very much. I appreciate it.